Hey there, and welcome to our not so live broadcast anymore. So, if you haven't noticed, this is not a live broadcast, so we're going to change it up. So, let me explain to you how we're going to do from now on. And we're going to try to make a pretty good schedule so you get used to it. You can join us live once per month when we actually have a guest on. And so, the routine is going to be like right now, we're doing a financial planning subject, then we'll have a live guest on, then we're going to do our book review. Then we have a break, and then we cycle over and over again each month. So we think that we'll be able to make a better production for you, being able to record these and add some extra details and what so, rather than going live all the time. But we still like the live thing. We're just gonna cut it to once a month instead of every week. So let's get into our financial planning subject for today. You want to introduce it, Tony?
Sure. We are going to be talking about Charles and Catherine Parker. Really, most folks who have small businesses do not utilize or often don't the right retirement plan for their business. And that is often because most financial advisors don't understand all of the options available to them. So you really, as a small business owner, have, especially if you're an individual, have a ton of flexibility in what you can do, depending on how much you can put away and how much you're looking to reduce your taxes. So
yeah, and you don't even have to be like a wealthy small business owner, like I think people have in their mind. I mean, there are tons of times where you may go through and you get classified as a 1099 employee for a certain period of time, or a lot of people may not necessarily think themselves as owning a big business or what so, but maybe you're a realtor or an attorney that or accountant that hung out their own shingle, and so this applies to you. And you may have years to where you have higher income and some lower, just depending on things that are going on. And it's not something that, we have to say is going to happen all the time. But it is something that can definitely help a lot of people out that is often overlooked. So we're going to share our screen right here with you so we can kind of run you through this scenario. So looking at it here, this is kind of a normal couple. We put them in their 40s, so they did have some time to save some things up. They've obviously lived within their means. They don't have a ton of debt or what so. So if we actually just look at their balance sheet, you can kind of see where it is here. They've got some savings. And again, for most people, it wouldn't look exactly like this. You might have like 3 different savings accounts, one for each of your spouse and a joint one, and maybe one for the business side of things too. But we just kind of lumped everything together for their savings in one just for simplicity purposes. They do have some investments, so somebody's helped them out to just say you don't need to keep over hundreds of thousands of dollars in cash to where the bank's not paying you anything. And then Charles has got an old IRA, and Catherine's got her 401k through work, and then this Charles is a realtor, and so we said his book of business or what's say maybe got handed down where he's got all these relationships and network from where his dad, even before him, had done things. And so, that is worth something, okay, if you could find the right person to buy it from him. Now, on the flip side, when we do planning for people, we'll show them what would happen if that, kind of ended not well, and they weren't able to sell that business. So we would really need to harvest it for income as long as we could, assuming that they weren't going to get it. But then we can assume to the upside that what happens if you did get it.
Well, in looking at the balance sheet, I mean, obviously a huge chunk is in his real estate firm, right? Mm-hmm. Nobody expects that their business is going to go under, especially if you're in the service business. It's less so. But if you can transition some of the money from the value of the company into your retirement account,
safer.
It's safer. You're protecting that money. So it's if you can do it and save some money and protect yourself, it's just more the reason why you should be doing that.
Well, we wanted to kind of give you the background there so you can see that. And then when we look at this, just so you have the full picture here, you can kind of see Charles here right now is earning $150,000 a year. And Catherine, say she's kind of working 3/4 time as a tech or something. Making $50,000 a year and has a 401k. Maybe it's a 403b if it was a hospital. It's kind of irrelevant to the plan. But just, the picture now. So together they're making $200,000. They have 2 kids, like 8 and 11. So let's kind of dig in. And so if we really look to say if they wanted to retire kind of normal around 65-ish right there, and in this one just for illustrative purposes, because we didn't want to do tons of scenarios to make this too long, we did assume that they'd make a good rate of return, about 7 to 8% per year. And we do want to put a caveat to that because the last 25 to 40 years, the average investor made between 4 to 5% per year. All right, so this is even for most people a little bit rosy, in terms of they build up and then they kind of spin down, but they still have money. So, the way that they're going, it would work good, but that is assuming that everything went well for them investment wise. So, one of the things we kind of want to show is exactly what this financial planning video is about, and that is, just like Tony said, let's harvest some of that and save it into some kind of retirement plan. And there are multiple ways you can do this. I will say we see a lot of accountants and realtors really get into this, which is a SEP IRA. Right?
Yeah, they default to it. It's a pension plan, basically all employer contributions. And so the employee is not putting anything into it, but it does have some limitations. One is, to me, the biggest one is you can't make any Roth contributions, after-tax contributions, so you lose some flexibility. And keep in mind, no matter what the investment is or the account type is, the investments are going to look the same. It's just that, in a lot of tax planning and things like that, some are going to give you more advantages than others.
And you got to be careful. Because SEP IRAs work just fine, and they're really simple to administer, and you can have most investments inside of it, so they're really plain vanilla and easy. A lot of accountants will recommend them to people that are eligible for them because of that. But the thing you got to be careful is, if you were to have actual employees that were like W-2 employees, you have to put a lot of money in their account. And so most of the time you don't want to have a SIP when you've got other employees that aren't related to you or somebody that you really want to take care of, because it is an expensive way to have retirement. But if it's just you and maybe you have a 1099 younger realtor or professional that works with you that's kind of doing their own thing with you, helping you with your business, but they're kind of their own thing, again, you don't have a problem there. But again, you should talk to your attorney to make sure that you're not classifying your employee wrong, because a lot of people do that, saying, well, I don't want to pay the Social Security and the other employer baggage that goes along with that. But a lot of times it's not your decision. If you're employing a person a certain way, they're supposed to be W-2. So word of caution there. So if you start to graduate up to the 401k and you have employees, then now you can do it in a way to where you don't have to give them near as much. It's still a great benefit as an employee, like a lot of other people have with their 401ks or 403bs. But then you will need to hire someone to do all the government filing and testing to make sure that you're giving them the appropriate amounts. But what we're illustrating here, again, is kind of simpler. And so we did an individual 401k. An individual 401k is kind of like the SEP, except you get some more options like Tony was talking about. And you have the opportunity to make, up to the employee maximum of Roth contributions. So you can do some pre-tax, some Roth, so depending on how your taxes are, it can be really advantageous. And just to refresh your memory, give them the kind of the details between the difference between pre-tax and Roth.
So, any money that comes from that is pre-tax, it's going to grow tax deferred, but then when you go to withdraw, it is going to be taxed at that time. So 100% of it is going to look like income. The after-tax, which would be the Roth account, is going to not get a tax break at first. It's going to go in after taxes, but then it's never taxed again. And so usually as we play with these plans, we can come up with one that quantitatively looks to be the best. But the reality is we don't know what tax rates are going to look like in the future. And you do not know. Anytime you pull that money out of a traditional account, it's not only going to be taxed because it's income, it's going to appear as income. And that can put you into tax brackets that can be disadvantaged for other reasons, whether it be Medicare or whether it be the Affordable Care Act, depending on where you're at. So it can have some other consequences. Social Security can be impacted. So having a balance, I think, is good at times.
Yeah. So pre-tax, you get a deduction now, pay taxes later. Roth, you pay taxes now, you get to grow it to hopefully multiple times and get to keep it all tax-free. So they are very different, and it's nice to have a mix. Sometimes you just may be doing really good, And you want all pre-tax because you're getting slaughtered tax-wise, and it'll be better later, especially if you're a late saver, which I have seen a lot of successful professionals. They spend a lot of time in school or starting a business, and it took them until mid-40s to early 50s before the money started rolling in, and there's not a lot of savings. And so you really need to slam it in while you're making that money for the last, 10 to 20 years. And the pre-tax could be really advantageous for you. So looking at this, you can see, and we already backed out inflation, just by doing that, and saving or having the same amount of money, kind of getting that tax deduction, extra way to save where the government's helping out, adds a $500,000 to their plan over the coming decades. Now, if we said, do an individual 401k, which is the exact same amount of money being saved, except we did 19,000 Roth and we did 37,000 pre-tax, because of that kind of mix for this person in this situation, and actually added over $200,000 in net worth by the end of life, which is the exact same amount of savings, right? So it's not always just, I think common sense wise, it's like, well, if I can defer taxes and not pay the government right now, it's always better. This is a pretty glaring example that may not always be the case.
Right. And keep in mind, it's only the employee contributions that can be Roth, right?
Mm-hmm. Yep.
Any of the employer, so the advantage is the employee contributions are done by December 31st, no later than that. But once you have found out how the company does, you could, there might be some variance in what kind of employer contributions you can make, but you have until tax time to do that. So you have a little more time.
So we're going to show you kind of three more things before we wrap this up. We want to give you things to think about. And if it does kind of spark your mind to thinking, or maybe this is not even your total situation right now because you need all your income, but in a couple years from now, things could change. And so that's kind of what this next one says. It's like, all right, let's say that 8 years from now, that Charles's business really does well, and it bumps up to 250,000 instead of the 150,000. So it bumped his income up, which is obviously going to make the plan better just because he has more money, right? And so you can see without any of the retirement stuff, it's making an even larger impact because he needs more tax deferral. One of the things that very successful businesses can do is kind of make their own pension plan. And the government allows you to defer more money pre-tax to do a pension plan versus just the traditional kind of investment 401k. Now, if you do have employees, proportionally, you're going to have to put more in for them. But for most of our clients that are lucky enough to be able to do a pension and willing to do it, I mean, the tax benefits way outweigh the extra money that are given to the employees, and it's a true win-win in the fact that, man, you made a way better program for your employees, and they're going to be better off, and you came out way ahead too because of that tax savings. So with that, you can go additionally above. In this illustration, obviously we bumped his earnings up by 100,000, but we said we put a pension in where for the last kind of 10 years he put an extra $75,000 in pre-tax, and you can see that it's just a huge thing. And even with the income bump here, if he wouldn't be doing the retirement stuff, yeah, it's great to make extra money, right? I mean, but it's almost a 3 times better situation, to use those tax preferences efficiently. So, again, if you're listening to this and this isn't your situation, but it could be, this is a really important thing to kind of take in and digest, because I tell you, 9 times out of 10, when something like that happens for someone, what they end up saying is, or what ends up happening is, well, let's move from our $500,000 house to $750,000 house, and do this and this and this and all these extra things, and their cost of living goes up and swallows up more than what the extra green would be there. Whereas if we could take some of the extra savings, because if you consume all that money, it's going to raise your taxes a ton because you just spend it all, and that's kind of like what's going on here. Beyond just the extra spending, the multiplicative effect of why it's so much more using those retirement plans is because by being smart and using good tax arbitrage and not having to consume all that right away, we gave the government a ton less, and then even got to grow the government's money to more, in a lot of cases tax-free for a part of it here.
Yeah. Well, you're describing income creep, right? I mean, the more people have in the checking account, the more they're going to spend. So stop yourself from doing that. We all want nicer things. So just think of the future more and think about you having more control later down the road.
And then, you can do more things. And so, like in this situation, I put, all right, well, what if he retires 8 years earlier? That says this, but it's selling the business in 2036, to kind of coincide with that. Give extra money to kids and charity. And it doesn't even require any downsizing or anything, and they still die with a sizable thing. So, like, there are all kinds of things you can do by making good moves. It's great to do planning like this because you can use your resources efficiently. Not to die the richest person in the graveyard necessarily, but maybe you could retire earlier. Maybe you could help your kids out more. Maybe you could help charity or your church or whatever you wanted to do to make your life and other people's lives better.
Yeah.
And it can be a great thing.
Often when we're implementing this for people, and this goes to show how important planning is, we might be saving them tens of thousands of dollars a year. I mean, in taxes, it goes a long way. And so once you start to make the type of money or you've accumulated some, a financial plan, which includes a lot of tax planning, becomes essential.
Yeah. Well, we appreciate you guys tuning in. I want to make you aware we're going to give you the next 2 books we're going to do. So again, we're still got the screen sharing up. You can see it here. The next one we're going to do week after next, because we'll be off next week, kind of just for the early Christmas, is Tribes by Seth Godin. It's a great book. It's really quick. I mean, so if you wanted to read it, I think the Audible is only like 3 some hours, almost 4 maybe, but that's super quick, But it's a really good read. Hope that you get a chance to read it and maybe follow along with us. The next, Tony.
The next one is the Book of Joy, and as you can see by the cover there, Desmond Tutu and Dalai Lama, they exchange letters, right?
Yeah, they do for a long time, and then they end up getting together and
then making this book. So we're interested. I have not read
2 great people.
Yeah, 2 great people.
Awesome people.
Combining, 2 very wise people combining their thoughts in this book. So we're doing this one. It's longer, of course. This is one we'll be doing in January. So
totally different beliefs, but it's amazing the synergy of just like 2 good people that are that well, say, educated and experienced coming together. It's really good. So I hope you'll join us as we kind of evolve our live broadcast. Appreciate you tuning in today. We do hope that for some of you this helps you. If it's not totally applicable to you, maybe you learn something new that could help somebody else. And we can all do better together, right? It's not just a pie that's the same size and we got to fight each other to get a bigger slice. We can make it bigger.
That's right. So it'll be fine. So 12, what is it, 14 days from today, which means Christmas is 12 days from today. So I guess today is the 12th day of Christmas, right, as we wind down here. So.
Well, thanks so much for tuning in. Hope you have a Merry Christmas, and if we don't talk to you or see you, Happy New Year, and we'll see you next time.
Yeah, take care, everybody.